Australia's two biggest property markets, Sydney and Melbourne, are often compared, but in 2026, the question has shifted. Instead of asking which city is more expensive, buyers and investors are increasingly asking which city offers stronger investment potential going forward. In this video, we'll compare Melbourne and Sydney side by side. We'll look at prices, growth prospects, rental performance, risk, and which types of buyers or investors each market tends to suit. The aim here is clarity, not hype, so you can decide which city aligns with your strategy in 2026. Let's start with pricing and affordability. Sydney remains Australia's most expensive property market. Median house prices are noticeably higher than Melbourne, and entry costs are substantial. This creates a higher barrier for many buyers and first-time investors, but it also reflects Sydney's long-term land scarcity, strong employment base, and global city status. Melbourne, while still expensive by national standards, is more affordable by comparison. Entry prices are lower overall, and there's a wider range of suburbs across different price points. For many investors, this makes Melbourne more accessible without pushing borrowing capacity to its limits. From a pure affordability perspective, Melbourne has the advantage. However, price alone does not determine investment performance. Next, let's talk about population growth and demand. Both cities continue to benefit from population growth driven by migration, education, and employment opportunities. Melbourne historically has been Australia's fastest-growing city, and that trend is continuing into 2026. Population growth supports long-term housing demand, particularly in the rental market. Sydney also benefits from migration and job creation, but growth is more constrained by geography. Limited land availability puts long-term upward pressure on prices, although it also limits how quickly the city can expand. In simple terms, Melbourne grows outward and upward, while Sydney grows tighter. Each dynamic creates different investment outcomes. Now let's look at supply. Melbourne has a larger pipeline of new housing, particularly apartments. This keeps prices more competitive, but can also create oversupply in specific pockets, especially inner-city unit markets. Investors need to be selective about location, dwelling type, and long-term demand drivers. Sydney's supply is more constrained. Planning restrictions, land scarcity, and infrastructure limitations restrict new stock. This tends to support long-term capital growth, but it also means higher buy-in costs and, in many areas, lower rental yields. Supply risk can be higher in Melbourne if the wrong asset is chosen, while Sydney often carries higher financial risk due to larger loan sizes. Rental yields are another key factor. In 2026, Melbourne generally offers higher gross rental yields than Sydney, particularly in middle and outer suburbs. Strong rental demand from students, migrants, and young families supports this trend. Sydney's rental yields are typically lower, especially in premium suburbs, but vacancy rates are often tight. Investors in Sydney tend to rely more on long-term capital growth rather than short-term cash flow. This creates a clear distinction. Melbourne often suits investors seeking a balance between yield and growth. Sydney tends to suit investors prioritizing long-term capital appreciation who are comfortable managing lower cash flow. Risk exposure is where the differences become more noticeable. Sydney investors are more sensitive to interest rate movements due to higher loan sizes. Even modest rate increases can have a significant impact on repayments, increasing holding risk if income buffers are limited. Melbourne investors face more market-specific risks, particularly oversupply in certain apartment zones. However, loan sizes are generally lower, which can provide more flexibility during uncertain market conditions. Neither market is risk-free. The risks are simply different. So which city performs better over the long term? Historically, Sydney has delivered stronger capital growth over long periods, driven by scarcity and global demand. Melbourne, however, has shown consistent performance, supported by population growth, economic diversity, and relative affordability. In 2026, the gap between the two is less about which city is better and more about which strategy fits the investor. Sydney may outperform in capital growth during strong market cycles. Melbourne may outperform in cash flow stability and accessibility, particularly for investors building their first or second property. If you're enjoying this, hit like to help more people find this video.
So who should choose Sydney? Sydney often suits investors with higher borrowing capacity, longer investment horizons, and strong income buffers. It also suits buyers focused on established, blue-chip suburbs, where long-term demand tends to remain resilient, even during slower market periods. And who should choose Melbourne? Melbourne often suits investors seeking diversification, stronger rental yields, and more suburb-level opportunities. It also suits buyers willing to research carefully to avoid oversupplied pockets and focus on fundamentals such as transport access, employment hubs, and family appeal. Here are 3 practical takeaways for 2026. First, don't compare cities in isolation. Compare specific suburbs and dwelling types within each city. Second, align your city choice with your financial position. A market that looks strong on paper may not suit your budget or risk tolerance. Third, remember that time in the market matters more than timing the market. A well-chosen property in either city can perform well over the long term. To sum it up, Sydney offers scarcity and long-term growth potential, but at a higher entry cost and higher financial exposure. Melbourne offers accessibility, population-driven demand, and generally stronger yields, but requires careful asset selection. There is no universal winner in 2026. The better investment city is the one that aligns with your strategy, risk tolerance, and long-term plan. If you found this helpful, subscribe for more property insights.